All right, so try to leave a little time for questions at the end. I am going to put the Q&A away, minimize myself, and get started here. So we entered February on pretty solid footing with our January Barometer for 2026 positive. This is affirming our bullish outlook for 2026. We'll get into that in a bit. Well, there are some troubling events transpiring out there domestically, geopolitically. If you tune out the noise, you will see that the underlying bullish foundation is solid and economic growth remains resilient. AI spending and the productivity gains continue to fuel growth. The Fed's interest rate policy remains stable while on pause. Inflation appears to be somewhat controlled, so they don't have to raise rates or make any rash moves, which is comforting. Employment situation looks pretty good. Today's numbers were helpful. People have gotten worried about that, but bottom line, market prefers rate stability. So don't be alarmed by the breather we took here in February. There might be some more, but I think the low may be in, as I'll show you momentarily. And the macro backdrop of the AI super boom in the 6th year of the presidency, the second midterm year, economic and corporate data and market actions suggest the trend remains bullish. So just for those who are not initiated, I know there's a lot of people that are familiar with what we do. We've been on the street for 60 years. The 26th edition of the Stock Traders Almanac is the 59th edition. The 2027 will be the 60th. I will be 60 at the time we send it off to the press. I was born, bred, weaned, raised on pattern cycles, market history by my illustrious father, Hirsch, who started the Almanac back in 1966. His fun title, Don't Sell Stocks on Monday, was his book from, I think that was 86, that hardcover came out. And my Super Boom book, which came out in 2011 based upon the 2010 forecast, which is still going on. We've upped the ante on the 3820, is based upon a cycle that he discovered back in 76. Here's the original copy of the Almanac, the little book of stock market cycles, my Almanac investor book, and some of the places we get to here. So Super Boom's in full swing. AI is that culturally enabling paradigm shifting technology that is part of the Super Boom equation. So, you know, the STA, the Almanac, as we call it, STA was a big hit right out of the blocks back in 67. But over the years, it has arguably become one of the most influential book on Wall Street. It's been on the desks of top money managers, traders, and advisors throughout the world for 7 decades. We've sold over 1.5 million copies. People sometimes, try to call me legend. I refer to myself as son of legend because my father was a legend. He invented the Santa Claus rally, the January Barometer, the best 6-month strategy. He put the 4-year cycle on the map, coined the phrase Octoberphobia, and if Santa Claus should fail to call, bears may come to Broad Wall. You'll remember that S&P wise, it just missed, it just failed a little bit. And I like to say, forget sell in May and go away. You got to buy in October to get your portfolio sober. We all know that those who fail to remember the past are condemned to repeat it, but I like to think that those who understand market history are bound to profit from it. My process, our Almanac process, we basically research and test every trend imaginable. We publish it annually in the Almanac. We update it weekly and monthly in the Almanac Investor Newsletter. We use all this information to construct portfolios based off seasonality, cycles, and history, but also lean heavily on technicals and fundamentals, internals, sentiment. Internals are looking pretty good right now, by the way. Sentiment's a little frothy. Monetary policy and geopolitics and current trends of the economy. So stay ahead with my newsletter, Almanac Investor. There's a code here where you can save. This is one of the best deals I ever offer. $175 for 1 year, $295 for a year. So if you want to stay on top of my signals as they develop, consider joining the newsletter. Members receive weekly market updates, key seasonal insights, and my latest stock and ETF ideas. If you do the 2-year, you'll get an Almanac every year, or whenever you're a subscriber, you always get the Almanac. So right now, you'd probably, if you did 2 years, you get 3, 26, 27, and probably 28. if you stay with us. So today's takeaways. January Barometer is positive. That affirms our best case scenario for out of my 2026 forecast for an 8 to 12% gain. So I'm going to run through the January Barometer and other early year indicators. Then I'm going to dive into the updated outlook, talk about when we might expect that next battle weakness during the weak spot of the 4-year cycle during the worst 6 months. We'll get into our 5 disciplines, market at a glance. February, the weak link. Maybe I think we got the low in there already. Fundamentals have been mixed, but we've seen some decent numbers out there. There's some rotation going on as well. I think a healthy rotation. Excuse me. Technicals consolidating a little bit. There is a bit of a trend of higher lows, and we found some support, and also a trend of rising advanced decline line. Monetary policy, kind of a wait and see cutting cycle, but still easing. Sentiments elevated, it pulled back a little bit, but still, those bullish sentiment indicators can stay lofty for a while before any sort of top or correction, sizable correction transpires. Then I'm going to get into some of our sector ETF portfolios, the stock sectors, and it was really cool and affirming how we hit a bunch of sectors like energy and copper ahead of the rotation, and those are some of our best performers right now. And then after we run through that, we'll do a little bonus update of some of the commodities and Bitcoin, which is quite out of favor and on my not on my good list anymore. So just a quick look at the December low indicator. There was a lot of talk about the December low, being crossed. It's an old indicator. It's in the Almanac on page 36. Lucian Hooper from the old days, he was a Wall Street analyst, Forbes columnist, said forget about January and that stuff. And if the Dow crosses below the December closing low, watch out. Well, that's all well and good, but if it doesn't happen early enough in the year, how good is it? It's something to be looked at. We went ahead and ran it based upon the S&P, even though Hooper's indicator was on the Dow here. This is the S&P numbers. You can see that when you had a down January and it crossed, it's worse. Up January, kind of deactivates it. So it's something to keep an eye on. The December low was what way down there, December 19th or December 6th back there. So I think we're far away from there, not something to worry about. But the January Barometer is really what happens, what's most important. And just a little bit on why it works. You can see here, this is the accuracy ratio for all the months versus the calendar year, the next 11 months, and the next 12 months in the blue bar. And you can see that, the January Barometer is all that really matters. It's a perfect combination of indicative power and early signal. Santa Claus rally in the first 5 days are helpful, but they're short time frames. Any sort of event can can impact it. The December low indicator is useful, but it can come as late as March 31st, which is well into the year. But the reason the January Barometer works is the lame duck amendment to the Constitution, the 1933 amendment that moved new Congresses convening in January following the election versus the following December 13 months later. That's why they were called lame ducks. It also took Inauguration Day and moved it from March 4th to January 20th. And then it took a little while for it to impact. It was ratified in 34, but the congressional margins were so lopsided for the Democrats that it didn't really start to have an impact until 1938, which is when we start this analysis. So all these events that transpire in January, money coming into the market, all the new outlooks, present company included, agendas and fiscal policy from the federal government and Congress and the White House, and you can see why January the barometer is pretty effective. So just want to give you a little final take on the trifecta. Last time I presented, we talked about the January indicator trifecta, which is on page 20 of the 26 Stock Traders Almanac. when you hit the trifecta, that's the Santa Claus rally, the first 5 days, the January Barometer, all up. The year is up 90.6% of the time. The next 11 months up 87.5% of the time. Average gains for the year is 17.7, for the 11 months 12.2. 29 out of 32 years, or 20 out of 32 years, so it's pretty solid. But this year we didn't get all that. Excuse me, we had a down Santa Claus rally by just a fraction. The Dow was up for whatever it's worth. I think that's not necessarily so significant, but more importantly, January up. You can see we're just putting up here the few years where you had Santa down and first 5 days up and January up. Pretty solid returns. Only one bad year, 94. Not even that bad, just kind of flat. So tune out the noise. January's positive, and that's good for the whole year. So just zoomed in on the lower part of this table here so you can see it. We've got the 11 months and full year change right here. This is when January's higher. Just January alone up 89.1% of the time, 41 out of 46 years, 17% on average. For the next 11 months, it's 87%, 12.2. I mean, just pretty amazing. So just focusing on positive January, solid track record. And then just to really try to dispel any of the haters or the skeptics, this is a table showing, a chart showing the outperformance of any up month versus it being down over the next 11 and 12 months. So when January's up, you have the next 11 months up 11.8%. When it's down, it plummets to just up 1.2%. So you got a net gain of 10.6. For the 12 months, the net gain is 11.5. And you can see, compared to all the other months of the year, it's just none of them come close. So January Barometer rules, none of them come close. Pretty solid confirmation of our bullish outlook coming into the year that we put out back in December, about 2 months ago. Here is the highlights, or just the crux of our forecast from the forecast issue back in December 11 of last year. We gave 70% probability to the and I'll show you the chart in a second, the 6th year of the presidency really having an impact. This is where the two-term president really tries to cement their legacy. And we'll probably have some weakness in the middle of the year, Q2, Q3, and then a late Q4 rally. Things continue to move in a positive direction. Best case, everything just crushes it. Another full year gain of 20%, 10% probability. Worst case scenario, you get an ugly, old school, volatile midterm election year, policy flops, inflation surges, labor market, deteriorates, hotspots flare, earnings roll over, or valuations get reset, and we get a mild bear market teetering on recession with negative to flat full year performance and losses across broad asset classes. That's not happening. You're hearing the numbers coming out right now. So our 8 to 12% base case is in play. Another historic streak that we're encouraged by, the Dow has gained at 1.7% this past January, pushing the win streak to 9 months in a row. This is just the 7th time since 1901 that the Dow has been positive in 9 consecutive months or more. So reviewing these previous 6 times, you can see that 1 month out, the gains are pretty solid, 3.17%, 2 months out, a little bit more, 5.3%. But then they start to flatten out over 3 and 6 months. And it's to us, being seasonal and 4-year cycle people, it kind of looks like it has us running into the end of the best 6 months, April, May, and then with further upside, and then seeing some typical Q2, Q3 midterm weakness during the worst months. And that's during the weak spot of the 4-year cycle, and which sets up the sweet spot, which is the best 3 consecutive quarter span from the midterm year Q4 through Q2 of the pre-election year. So right now, this is the 4-year cycle from post-World War II, 49 to 24, with the current cycle, 25, and so far this year, this is as of yesterday's close. You can see, we got a very, despite the tariff tumble, we did get a more bullish post-election year pattern based upon the, more recent since 1985 performance in post-election years. This is all midterm years, not the 6th year, so this kind of weakness might be a little bit muted this year, considering that the year we're in, though. The midterm elections promised to be heated with the razor-thin margins the Republicans hold here. So far we're tracking the 4-year cycle, probably end up, peaking out around, or at least pausing around end of Q1, early Q2, and sideways to a little bit of a pullback into Q3, the August, October period, very typical midterm year. We had a textbook midterm year low in 22, which if you were around, you saw us, we called that pretty solidly. So this sets us up for the potential for what we call a near 50% gain in the Dow from the midterm low to the pre-election year high. That would be 26 to 27. Yes, we're measuring a low to a high, so they're all going to be positive here, but we're trying to underscore just this sort of sweet spot here that's happening, that has happened over the years historically. So you can see a couple of things here. Average gain is 46.3%. I'll call it 50 for argument's sake. It's been a little bit quieter the last several cycles, but you can see a lot of Decembers on the and this is from page 34 of the 26 Almanac for those of you that are following along or that are thinking about getting a copy. A lot of Decembers, a lot of last trading days or close to last trading days that were the high for the year, that this will be next year, 2027 pre-election year are made. So that's kind of interesting to me. A bunch of Octobers in here. And I'll tell you that NASDAQ is even, as you could imagine, more pronounced. From the midterm low to the pre-election year high since 1974, NASDAQ gains a whopping 66.6%. That's 66.6% from the midterm low to the pre-election year high. So this is why we call it the sweet spot of the 4-year cycle. And we'll be looking for a rally in late Q3 or early Q4. Maybe, as I said, in the August to October time period, then prepared for that sweet spot and a rally, to more new highs and beyond. After that, we'll reevaluate. This market can't go up forever, but the bull market is still alive. So here's the 4-year cycle. The midterm year cycle pattern that we're looking at, that we're tracking right here. You can see in the pink line. I guess it's hot pink for me. I don't know what it looks like on your screen, but you can see 26 sort of tracking along these patterns. We had the little February dip, maybe a little bit earlier, but what we've got here is all midterm years in the blue line. That's all of them. The 6th year of the presidency in this red line. That's where presidents try to really cement their legacy before the midterm elections. Second, Republican midterm years. I know people say this is different this time and it's non-consecutive and there's really not much to compare it to. There's only one from the past. But from my vantage point, or my point of view, it's still the second term, and President Trump is still not going to be running again based upon the Constitution, and I don't see them changing that anytime soon. So it's still a second midterm year, or the 6th year of the presidency in my book. And the black line here is the aggregate cycle. This includes the year of the decade, in this case, the 6th year of the decade, 2026, not the 6th year of the presidency. And this is kind of where we get, and all years as well as all midterm years. So this is where we get that 8 to 12% range right off this chart. It's no secret. but this is the analysis. This is the cycles that we're looking at. So just looking here at February, you can see, we've kind of tracked this pattern here, this little February low in the midterm year. February, as you may know, is what we call the weak link in the best 6 months. This is the updated through yesterday's close February market performance in the dotted line, which is on the right scale, versus the midterm year going back to 1950, since we're in the midterm year here, and then some of the midterm year stats here showing that it's better midterm year. But the lows are likely in here, and we've had our February break. Early last week, it looked as though February was going to once again live up to the weak link reputation. But after posting, that big turnaround rally, that surge on Friday, the big across the board gains, and sort of hanging on to them here. I think we're sort of, as I started this program here, looked like we were about flat, give or take, depending on what index we're looking at for the day. Looks like the lows are in, and barring any exogenous event or black swan, it looks like we're going to have some additional upside, maybe a little bit flattening towards the end, post President's Day, which is a weak seasonal period, and then finish the month on an up note. This is all about trend, not necessarily level. So look for additional gains in all the markets, and I think small caps, Russell 2000, likely to be a little bit stronger. So that's the seasonal look. Let's get into some of the other, market at a glance, 5 disciplines that I promised you. Fundamentally, government data is still lagging with the shutdown, but real GDP was up 4.4% in Q3. The Atlanta Fed has Q4 estimated down a little bit to 3.7. Still pretty solid, pretty steady growth from our point of view. Big tech earnings, have been a little bit mixed. Corporate guidance clearly as important as ever. A lot of volatility, or not a lot necessarily, but quite a bit more than last year. But other than the some of the government numbers, corporate earnings might even be a better indication. As I said, the data collection is still pretty screwed up from the shutdown, and who knows what they're doing with seasonal adjustments. Amazon's revenues, Q4 revenues, were pretty strong, up 13.6% compared to 2024. It might not be all of retail, but I don't know. They got a pretty big corner on retail on a lot of things, so even transports. And one of our stocks, Boot, which I own, was revenues were up 16%. Stock's off a little bit. Maybe it didn't beat as much as it wanted, but its revenues were still up 16% for the quarter. Actually did some shopping there over the holidays down there in Paramus, New Jersey. Inflation rising, but actually kind of flattening out here. It's running above the Fed's target. I don't think their target is realistic. I don't see it's getting to 2% inflation, but I'm no economist. The numbers that I looked at, going through the Fed database with the CPI back to World War II, even before that, about 3% average on the CPI. So maybe we might get a little bit below that, but that seems to be the average. Some of the technical, QE purchase to maintain the funds rate, to keep it within this 350 to 375 range are happening. Looks like QT's over. I think it's wishful for 2%. It looks pretty solid for me. The market seems to be enjoying it. On the job front, good data number today, but our favorite indicator is the initial claims. There were some concerns that we had a spike around the holidays, but just to show you, this was a seasonal spike. This is the not seasonally adjusted numbers, so the seasonal spike shows up. We've always preferred the jobless claims because it's harder to manipulate. It's just people filing for, unemployment for the first time. We did a whole chapter on the manipulation and changing of inflation data and how they mask it in the Superboom book. So you can go look at that. And it claims are probably the most raw form of employment data as far as I'm concerned. Technicals. I find this advanced decline line very encouraging. It keeps hitting new highs. Literally more stocks advancing the decline. This is healthy broadening of the rally. Perhaps this run at 7,000 could be the one that finally breaks through. We heard some super bearish remarks out of Goldman earlier this week. It's a notorious contrary indicator, anecdotal, of course. And here I just highlighted our seasonal MACD buy signal on October 6th. We're above that. We've been, battling a little bit. Here's this trend of higher lows. We sort of made a slightly, maybe lower low. It's not, we came through this trend line a little bit, but we held this support here at the October highs. I like that. This advanced decline line, very encouraging. So we're getting more new highs, higher lows, more advancers than decliners. I don't know, still in the uptrend. The bull market rolls on. Interest rates are kind of in a wait and see cutting cycle. Probably not going to get any cuts until the new Fed chair, probably until June or after the new chair takes office. We're still, all of us, not quite sure what Kevin Warsh's policy is, what his angle is, but hopefully he will give less speeches and do more economics and not be out there like the current or recent Feds have been jawboning and commenting on everything and giving speeches when they should just be crunching numbers and doing their job and keeping track of the data. But the trend here is a little bit higher off of the real lows that everyone thought, but sort of flattening out here. So rates kind of not going anywhere. Clearly the odds, this was from earlier today, 92% going to stay the same in March. So this is encouraging. The market likes stability. Rates are steady. Economy's doing well. Job market's holding up, or at least not freaking out like everyone thought it was. So that's all good. Sentiment, a bit lofty. I like the investors' intelligence number. We're rated or surveyed in there as well. It's a measure of people who get paid for their analysis and research. The bulls were up over 60%. They slipped to just under to 59.6 from 62.3 last week. That was the highest high since November 2024, which was 62.9 just before we had the sell-off in early 25. So readings above the 60% level call for defensive measures, but, and this is a quote from Investors Intelligence from their service from John Gray, they occur early in the top forming process, which can take months. Bottom signals are much quicker, but basically it's elevated. I'm highlighted here. This is the difference between bulls and bears, up over 40%. So there's 40% more bulls than bears. But you can see the last, back in 24, we had a bunch of these, 24, 25, we had a bunch of periods of this lofty level of bullishness before the drop. So we can still keep rallying. I'm not expecting this kind of, I mean, this was, Liberation Day. But you can see a couple of correction we had when we hit here. Just highlighted a few of the pullbacks off of these lofty levels. So that's the market at a glance that we run through every month for the newsletter. And I want to get into some of the sector stuff, the stock sectors, and give you a little flavor of what we do here. Excuse me. We got in ahead of this rotation trade. I'm not sure I would call it luck. The harder I work, the luckier I get. But using the seasonal trades, the seasonal patterns. Copper, I own the copper miners, the COPX, up 43.7% as of yesterday's close. I think it was up a bit more today. The copper, commodity ETF, these are seasonal, trades. The sectors tend to make their lows. You can see it in the back of in the back section of the Almanac, pages 94, 6, and 8, all of our sector seasonal trades. We also, just looking at the trend back here, we picked up some of these foreign ETFs. I own these 4 also. Those are doing pretty well. So when we started to see the trend changing early, in the summer, actually late last spring, we got into these foreign ETF sectors. These are some of the solid, stocks here, the big, not necessarily all blue chip, but big companies paying dividends and value stocks in the Eurozone. So we're doing pretty well there. But, got into the energy sector, XLE up 20%. XCS took off. We had an auto sell, sort of a target price there. It hit 20% above the historical seasonal pattern, seasonal performance. So we closed that one out. Still in the XLE, and I just picked up the UNG on a bit of a dip. That's kind of off for us, but you got to be patient with these things. Still looking to get into the first natural gas. This is the companies. They get a little bit of boost from their oil production as well. So copper, energy, foreign ETFs, a couple of highlights here. You can see a couple of small red numbers, but generally the seasonal sector rotation stuffs worked pretty well and got us in way ahead of the rotation trade that everyone's talking about now. Just going to give you a little bit of look at the seasonal chart here. This is the energy. This is the XOI. This is the old oil and gas index is what the XLE is kind of based on, but it's got more data. Here's the seasonal pattern with that December low. Here's the low that we capitalized on. We usually put out our recommendation for these seasonal sector trades ahead of the seasonality beginning, so give us a chance to get in on the dip of the buy limit below the market. Nice trade there. And then the copper one, copper had that tariff sell-off or recovered from it. And with the, data center macro trend there and the build out, we got in, if you look back here, I'll show you the date on the table here. You can see this October 30th was the issue, the newsletter that we put that out in, getting ahead of that seasonal low here. We kind of got it in, copper in late November. So that worked out pretty well with a little buy limit below the market ahead of the seasonal trend, the bullish season. So this is again on pages 94, 6, and 8 in the Stock Traders Almanac 2026, and these are the trades and analysis from our Almanac Investor newsletter. So in a minute, I'm going to run through some bonus updates on commodities and Bitcoin, but first let's recap. Positive January Barometer firms our 2026 base case forecasts. There are some headwinds out there. There's a little AI uncertainty. We did get some tepid, bullish, tepid market action during the bull season. We had that, sell off there in October and November. U.S. politics will be an issue in the midterm year. Labor and inflation softening, rising remains to be seen. If they do rise, if inflation does rise and labor softens, that will be a headwind. There's definitely geopolitical issues. Iran seems to be, more in the forefront right now. Tariff uncertainty seems to be waning a little bit, but it's still there. Tailwind side, the AI super boom, the 6th year of the presidency strength, the January Barometer being positive, an easy Fed and a new Fed. GDP still, about above 4%. We'll see what happens with Q4. Mideast calm. I mean, it's never really calm there, but it seems to be less hot than it was in 23 and 24. The deregulation and the tax cuts are positive. So any new cuts we expect around mid-year. Look for some Q2, Q3 volatility, steady economy, stable job market, and 8 to 12% gains in 26. and the AI super boom continues into 26 and beyond. So you can stay ahead of all these signals as they develop when you join my newsletter, Almanac Investor. It's a great deal here. You can hit that QR code, go to the website, stocktradersalmanac.com. You get weekly market updates, seasonal insights, latest stock picks and ETF ideas, like I just showed you with the energy, XLE, and COPX, the copper trade there. And everyone gets a free copy of the Stock Traders Almanac every year. If you sign up now, you get a 26 and a 27. If you do the year, if you do 2 years, you get 3 of them. So let's look at Bitcoin crumbling. We traded this seasonally successfully a couple of times after I put out that Bitcoin seasonality study with the crypto burb. It seems to be over for now. I was in IBIT, I sold it at 52. It's now down under 40. So failed seasonal rally, midterm year record's atrocious. Just not a pretty chart from my point of view. Here's the seasonal pattern with the full year 2025 in orange. I've got the green line is since 2018, which is the first full year after the CME futures began trading, and the black line, which is, incredulous on some level, is going back to the beginning of the data in 2011, the first full year. I think it's data we can get is July 2010, and that's on the left scale, the black line. Last year and since 2018 is on the right scale. There was that October 10th deleveraging event. Perhaps that's had a deeper impact. There was this story about the Korean exchange, South Korea, that caused this snafu there. Just kind of has us concerned about the liquidity of Bitcoin. It's bounced around quite a lot, but just an old school skeptic sometimes. But the midterm election years have been horrible for Bitcoin. Can't do a chart of this. I mean, we could, but it's only three midterm years or 3 full cycles. The first midterm year with limited data, partial year of 2010. It's just kind of crazy numbers. This is percent changes, just insane. But 50% gain. 50+% losses in all the midterm years. So far this year, what are we down about 21% earlier today? There's been some serious drawdowns here in the midterm year, so we're concerned about that. We had some 70% drawdowns. What are we down about 50% from the high, roughly. 2010 to 2013, there was a 93% drawdown. 2014 to 2017, the 2017 drawdown was 87%. The 22 one was like 70%. So I don't know. This midterm year cycle for Bitcoin is concerning. Here's the current year. So the South Korean crypto exchange accidentally handed off 40 billion in Bitcoin. This is a New York Post article that we looked at. And I love the name of the place is BitThumb, like they put their thumb on something. I don't know. They said Bitcoin prices were 15 to 17% lower than other exchanges. They said 86 customers sold about 1,800 Bitcoins before the freeze took effect. So they stopped this from happening. I just doesn't seem like a real liquid market here. Very concerning. I think today it was down 23 or 24%. I didn't see where it closed as I started this up, but I don't know. Risk off, liquidity issues. Not tracking the seasonal cycle anymore. I'm out for now. We'll see what happens. Copper consolidating some gains. Still pretty solid. AI, autos, housing, demand not going away. Just watch out for the volatility. Basically, we covered from that July tariff hit, seasonal period from December, late November. We're in. So we'll be tracking that trade. It's up 43, 44% on the copper miner so far. That's pretty good, pretty solid trade there. Here's just the seasonal, midterm year seasonal pattern, purple line. I'm going to show you a bunch of these as we go through them. Midterm year in purple, and then the 6-year in green, all midterm years in the blue, and all years in the black. So, you know, here's that December to May copper rally, even more pronounced in the 6-year. So hang on. Use any dips to get in. Take a look at our buy limits in the ETF portfolio. Gold, you know, may have topped out here. We had a gold trade on from the summer, the fourth quarter gold. It's just a old school classic seasonal trade. We got at it around 390 or 3900 early, but we were up 27%. You know, the miners and the junior miners also hit our sell signals, both up over 20% a couple of months. So we're happy with those trades. But longer term, inflation, weaker dollar, global central bank demand likely to continue to support it, but I think the top might be in. You know, up this much, 23, 4, 5%, you know, kind of may have pulled forward this whole midterm year, six-year presidency pattern here. So just not thinking we're going to get more new highs at this point of the next several months. Silver stumbled, kind of follows gold, no position, kind of ran away from us. We didn't get the SLV that we were looking for. If you're in it, you know, I would tighten up a stop or taking some profits. I wouldn't be chasing this. Again, I don't see any more new highs in the current cycle happening. Over the long haul, probably will follow gold's trend. Here's the seasonal pattern. I mean, up 60 some odd percent out of the blocks, revert to the mean. Maybe it bounces along this pattern for the year, but I don't think we're going to get that high again. Crude oil, the seasonal low is in. As I showed you in the weekly chart there, the trade with the energy stocks. So, you know, cold winter, unrest in Iran, put a little bit under it. But the Trump administration and, you know, anyone who's in inflation, wants lower prices, this keeps inflation down. So it still seems to be keeping a cap on price. This is as of yesterday's close. All these charts are yesterday's closes. Seasonal trade, I mean the midterm year seasonal trade, kind of bucking the trend here. Probably due mostly to the cold weather and the unrest overseas, but nice seasonal trade here. We'll take the seasonal trade. Natural gas is perking up. Again, we usually see a low around February. Got a little dip, and our UNG buy was hit. So there's a pickup in demand going on now that the heating season is here. The cold winter and the Iran unrest, military threat, sort of, you know, spiked up gas here also. The March to April, May, or June move is where we see this. Here's the seasonal pattern where we see this. These price spikes. The cold winter tends to draw down inventories, and then any spring cold or supply disruptions can trigger a natural gas price surge in the spring. So we're kind of lining up here pretty well, even though we're off a little bit on that UNG trade. I think we can get a rally into the spring. So that's the prepared remarks I have for you. Again, if you want to, maybe we can answer a few questions. If you want to come join us. Here's the deal. Let's see if we got any questions in the question box. There we go. Let's see. Everybody's still here. Some very long question. I'm not sure who asked this, but it's very long. JC is asking, do you have the midterm seasonality and the year ending at 6 seasonality, January Barometer, all combined in one chart? We do have that. It's not here, but we can. That's a pretty good question. Whoever the person before, whoever asked about this long question, if you want to reword something and a little bit shorter, I'll try to answer that. Let's see. You're welcome, CBN. Is anyone else out there? I want to ask a couple of questions. I think there we go. You got auto call, the only gas service. Do you think you will get it back in? Not this cycle, Eric. Good question. I mean, what we've learned over the years is to stick with the recommendations, that we do while the market's closed and while we're not emotional. But unfortunately, you do miss a couple of, you don't sell the top sometimes. So what are the chances for a bear market or midterm bottom? So two different questions. Bear market, as I showed you in my annual forecast, we give about a 20% chance to. A midterm bottom, I mean, you kind of always have one. I don't think we're going to have a midterm bear market bottom, but there is a 20% chance as per our annual forecast that I showed you. Why do you think gold and silver topped? Michael's asking this. It's a combination of the seasonal trend, the price trend, that big sort of blow off speculative top. I don't think it's top for the rest of time, but at least in the near term here, over the next several months, and maybe even settle back into a seasonal low over the summer. We'll get back into it again. Andreas is asking me, touch on any international outperformance. Yeah, I did. I showed you the ETF sectors. Let me see if I can get back to that. Oh, there we go. Here's the international performance that we have there. Without being too U.S. centric, a lot of the seasonal patterns track the U.S. seasonality, partially because of how much of the global economy that we control out there. But we've done some work, especially with China and Hong Kong and the Chinese New Year and some of the seasonal patterns there. So that's a whole other ball game. Stuart Seiden, I wonder if this is the Stuart that I know. How about balancing funds late April, early May, or early August? When you say balancing, I think you mean rebalancing. When we get into the end of the best months in that sort of May to June, July period, that is definitely a great time to rebalance. But what we like to do is limit new longs, tighten up stops, get rid of underperformers, and take a few profits and things, and sort of keep a little cash on the sidelines so we can get back in during those weak summer months. Thank you, Fritz. Glad you appreciated the presentation. Let's see. The Shiller-Cape ratio all-time says the market will flounder for the next 10 years. No, I don't agree. Dave said a lot of things that haven't happened. I'm not really enamored with the Shiller-Cape ratio. Steve Lee is asking, can we get monthly segment of market performance graph for midterm years 1950 to 2026? I don't think I can give you 2026 because it hasn't happened yet. But I think is this what you're asking for? Maybe you tuned in late. My seasonal 1 year's, yeah, here we go, the 1 year midterm year pattern. Maybe that's not it. I'm driving. Will there be a replay? Yes, JB. Thank you for tuning in from the road. I used to do radio in college, but that was music. We had a reggae show. and a rock show on the voice of AU Radio, WVAU. Anyway, I digress. There'll be a replay. There will be the slides if you signed up. You get an email. What's up, cuz? Thanks for tuning in. So yes, replays and slide deck will be emailed. You'll be emailed a link. Correction, midterm years, 1950 to 22. Steve, is this chart I'm showing here what you're looking at or what you're looking for? Because I think that's it. If not, please clarify. The incoming Kevin Walsh, this is from Michael, is a hawk. So bearish for stocks and crypto, gold, silver topped out when he was announced. If you say so, it remains to be seen what he is, but I've heard some of that. I can't deny that that's some of it. I'm pretty sure that the economy and the stock market are a little more powerful than any one man or any body. I don't know. I kind of look for the stock market to tell the Fed like it used to do. There's some old quotes from the Volcker years that we pulled out of some minutes back then, where they just said, basically, if the bond market moves outside of this window, then we'll adjust rates to follow it. They really should be, guardrails. So he may be a hawk, he may be bearish for stocks, but I don't think he's got that much pull over the stocks. Mark Wood, great question. Do you normally wait for seasonal opportunities versus getting in at current technicals? Yes and no. Yes, we do wait for seasonal opportunities, but we also use technicals in conjunction with it and fundamentals. So we don't just use seasonals, but and we do use technicals with it, but we do have a sort of a seasonal cyclical, cycle base that sort of drives our outlook and our stock picks and our ETF sector picks. Can we get a large screen to see each date of the month? That's a big ask. That's going to cost you. You got to subscribe or get a, I don't know. You'll have to reach out to us, email us, reply back to something, and we'll see what we can do. John Z, how is the team looking at energy, oil and gas sector? Seems a semi-bullish start only for larger caps. Small micros are not bullish at all. Thanks. Yeah, we're into the XLE right now. Didn't see a whole lot of action in the small caps, but I think the FCG, the first trust not has some smaller stuff in there. We're leaning large cap right now. I own the XLE myself, but I'm not sure the small and micros are the place to be. But that's a good question. We'll throw it at the team. You're welcome, Steve. I think we're getting towards the end. I'll pause for a second, let anyone throw in any last minute questions before I sign off, and thank you all for joining. So last call for questions. Oh, thanks, Eric. Appreciate you signing up. There's the link if anyone needs it. All right, everybody. No, Michael, we don't have software. We make recommendations and provide investment advice, specific trades, buy, sell, hold, buy limits, stop losses. Oh, why is software crashing? It's just the rotation of the month club. I mean, there's a lot of overreaction. It's tune out the noise. I don't know. It's AI is gonna change software, then it's not. I mean, I try not to get so I don't know, wrapped up in the cable news channels and the social media with everything being, the best and worst of all time. Let's just sort of tune out the noise and, okay. I mean, for bear market software, sure. I think bear markets are for the whole market, not individual stocks. I know everyone translates that there's a bear market in this, but not a bear market in that. There was rolling bear markets. I mean, in the old days, it was either a bear market or not a bear market. Yes, some stuff goes up and some stuff goes down. Some stuff goes down a lot. Some stuff goes up a lot. But, you know, looks like a bull market to me out there, aside from software stocks selling off. So, yeah, we got to rotate. True.
Hey,
Thank
Jeff,
you, Michael. Yeah.
I was just going to jump in. We had talked about this a little while ago. Remember the software companies that have good AI product. So remember we were talking about like AI, Microsoft has been hammered down, but they're not going anywhere. So they're entrenched with the enterprise customer, and those software companies, I think the sell-off is way overdone. So
By the way, this is Chris Mistel, my director of research and business partner. I guess he got it. No, I appreciate that, Chris.
The software question was AI fears are going to take over coding business. And the answer is, I think you can be selective now in the software business, companies that are entrenched with enterprise consumers. So that would be like, you know, Google with Gemini, Microsoft with Copilot. They're going to keep their existing enterprise customers and probably pull more revenue out of them for their AI products.
Well said. Thank you for chiming in, Chris. All right, everybody. Thank you for joining us. I'm going to sign off. Have a great day, and let us know if you have any follow-ups over email or Twitter or X, whatever, or anywhere else out there. Thanks again. Good night.